Welcome to the deep dive. This is where we take that stack of sources you send us, articles, research, maybe even your own notes, and really boil it down, find those essential nuggets of knowledge. Today, we're tackling the real estate market, but maybe not how you expect. We're aiming for a really rigorous look, going way beyond just, what are today's mortgage rates?
That's exactly right. I mean, everyone's eyes are glued to the Fed, understandably, but the sources you've gathered, they really push us deeper. We're talking about the basic economics, the sort of physics of property, how debt is used strategically, the numbers pros use to measure risk, and yeah, even that deep financial engineering behind the 2008 crash, and critically, the tax strategies, the stuff that really separates, let's say, a hobbyist from someone building serious wealth.
Okay, yeah. This feels crucial for anyone touching property, right? Whether you're just trying to figure out market trends or you're literally about to sign on the dotted line. We're trying to get beyond just asking, what's my monthly payment, and start understanding the whole financial world we're playing in. So let's dive in, starting at the root, the economics of debt, and this powerful, maybe sometimes misunderstood idea, leverage.
Okay, first things first. We really need to challenge a story you hear constantly, almost daily in the financial news, actually. It's this idea, this kind of illusion about low interest rates, this persistent myth that, current historically low mortgage rates are the main reason housing prices shot up so dramatically recently.
Right. And based on the history in our sources, that story just doesn't quite hold up. It seems to be using a pretty narrow and frankly turbulent slice of history as the benchmark.
Precisely. Let's look at the actual numbers. So today, you see 30-year mortgage rates, maybe 5% to 7%, somewhere in that zone. Now, that only seems low if your comparison point is the disastrous stagflation period, the 70s and 80s. Back then, you had high inflation. You had Paul Volcker at the Fed doing his aggressive Volcker shock thing. Rates climbed sometimes to a staggering 8%, even hitting 16% at the peak.
And that 16% figure, that feels like such an outlier, right? Caused by extreme measures for extreme times, just a tiny sliver of U.S. history, but it gets used as the measuring stick today.
Exactly. If you actually zoom out, look at the whole 225 plus years of U.S. history, mortgage rates have typically stayed in a much tighter band. Generally, somewhere between 3% and 6%. So the rates we see today, 5, 6, even 7%, they're actually more towards the high average end of the historical scale,
Yeah.
not the low end. And that completely reframes the whole affordability conversation. When analysts keep saying rates are historically low, they're usually just ignoring 2 centuries of data and focusing only on that high inflation blip in the late 20th century.
Okay, so if rates aren't necessarily low in the grand scheme of things, then the main tool for building wealth in real estate becomes even more critical. And that's leverage, using borrowing creatively.
Leverage is absolutely the cornerstone, at least for scalable real estate investing. It just means borrowing money to buy an asset, and by doing that, you dramatically increase the potential return on the cash you personally put in. The goal is simple, really. Maximize the return on your equity, your actual skin in the game.
And the sources had a really clear example of this. Like, it shows the explosive power. Let's imagine a house, okay? And in 1 year, it goes up in value, and you pay down the loan principal by a total of, say, $4,000.
Okay? Scenario A, you're conservative. You buy the house with a big down payment, maybe $100,000. That $4,000 gain on your $100K investment, that's a modest 4% return. Safe, sure, but slow.
Right. Now, scenario B. You go for maximum leverage. You only put down $10,000. Now, maybe the mortgage payment is higher because the loan is bigger. Maybe your cash flow for the year drops to zero. Okay, but you still get that $4,000 gain from appreciation and paying down the principal.
And this is where the math just jumps out at you. In scenario B, your return is that $4,000 gain divided by your tiny $10,000 investment. That's a massive 40% return. You got 10 times the percentage return just by using more OPM, other people's money.
Okay, hold on, though. If it's that easy to get a 40% ROI, why would anyone put down $100,000 for just 4%? I mean, what's the catch? What risk are we ignoring in that super leveraged example?
That's a million-dollar question, isn't it? Leverage is definitely a double-edged sword. It magnifies profits when things go well, absolutely. But it magnifies losses just as dramatically when things go south. If that same house dropped in value by just 5%, let's say, your $10,000 equity could vanish instantly. That could lead to foreclosure, a short sale, pain. The more debt you use, the thinner your cushion is against surprises, vacancies, big repairs, a market dip.
So it's about finding that sweet spot and managing the power. The sources mentioned a guideline, right, about the cost of the money itself. Try not to pay more than, 10% interest on the borrowed cash.
Yeah, that 10% figure is often cited as a kind of practical ceiling. Once you go much above that, the interest payments start eating so heavily into your potential cash flow and equity growth that the risk often starts to outweigh the reward,
Hmm.
especially when you factor in other costs like property management, vacancies, repairs. It gets tight.
Okay. And looking at how people actually borrow, especially smaller investors, home equity loans come up.
Yeah,
Secured lines of credit, the key being secured.
right. Because the loan is backed by the equity in your home, the lender sees less risk. They have collateral.
And less risk for them usually means a lower starting interest rate for you, the borrower. But
Yeah.
there's a different kind of risk there, isn't there, with the payments changing?
That's the catch, yeah. The interest rate on many lines of credit, like most ELOC's home equity lines of credit, it's usually tied to the prime rate. The prime rate follows whatever the big banks set, which follows the Federal Reserve. So your rate, and crucially your monthly payment, it can jump around, sometimes dramatically, sometimes unexpectedly. It's the trade-off, you know.
Yeah.
Like a lower initial rate, maybe, but you accept variable payments, makes budgeting and long-term risk planning a bit trickier.
And shifting gears to the bigger players, the institutional world, our sources confirm that entities like REITs, real estate investment trusts, they're also built on a foundation of debt. It's not just individuals.
Oh, absolutely. REITs are a perfect case study of just how pervasive leverage is at the highest levels. The data shows they consistently kept leverage ratios around 45% debt in the years leading up to the 2007 crash.
45%. So
Yeah.
nearly half their assets were financed with debt.
Exactly. And that ratio isn't random. It kind of reflects what the market, at that time, considered an acceptable level of risk for these big capitalized trusts.
And what does that tell us about the whole sector?
Well, it shows that high leverage wasn't just a strategy. It basically defined the risk profile for the entire institutional side, too. Think about it. If nearly half your huge portfolio is financed with debt, and then the value of those underlying properties drops suddenly, say, 15, 20% vet, the whole structure gets shaky fast. It doesn't matter if you're an individual with one rental or a billion-dollar trust. Too much leverage creates vulnerability. So seeing this pattern from individuals using ELOs right up to giant REITs, it hammers home that debt is like the operating system for the whole real estate world, which leads us perfectly into the next part. The tools professionals absolutely have to use to measure that risk precisely, the critical investment metrics.
Okay, this is where things get really interesting, I think. If you want to go from just, buying a house to live in to actually operating like a savvy financial player in real estate, then you got to speak the language. The casual buyer might just ask about the list price, but the professional, they're asking about these core performance numbers.
Precisely. These metrics are shortcuts, really. Ways to quickly gauge if a deal is even worth looking at, and crucially, how to compare totally different kinds of properties fairly. The first one, and maybe the most common for people focused on income, is the cash-on-cash return, usually called COC.
Right. So tell us exactly how that's worked out and why it's such a go-to for those cash flow investors.
COC is pretty straightforward. It's the simplest way to see how much actual cash flow you can expect each year for every dollar of cash you personally invested in the deal. The math is just annual net cash flow divided by your total cash invested. And net cash flow here means what's left after you've paid everything, operating costs, setting money aside for repairs, and making that mortgage payment.
Okay, so let's use that short-term rental example. Property costs $500,000, you put $100,000 down as your cash investment. And let's say, after everything, it spits out $12,000 in net cash flow for the year.
Perfect. Your cash-on-cash return is $12,000 divided by $100,000. That's 12%. Simple as that. And COC is vital because it tells an investor how fast their actual invested capital is coming back to them. It's huge for, say, retirees or anyone chasing financial independence because their main goal is often that reliable, steady cash flow replacing job income. A decent target for COC often starts around 8 to 10%, maybe higher depending on the risk in the market.
But COC is tied to your specific financing, right? How much you put down. So if you want to compare two different properties quickly, without getting bogged down in financing details, you need something else. Which brings us to the cap rate, capitalization rate.
Exactly. The cap rate levels the playing field. It measures the property's return based on its value, assuming it was bought with all cash.
Yeah.
So it strips out the effect of the loan. It's calculated by taking the net operating income, or NOI, and dividing it by the property's value or price.
And NOI is key there. That's income after operating expenses like taxes, insurance, management fees. But before you account for the mortgage payment, the debt service.
Correct. So cap rate really reflects the property's raw, unleveraged ability to generate income.
And how do people typically use cap rates in the real world?
Probably the most common use is to quickly estimate value. Let's say you're looking at a property and you figure out its NOI is $45,000 a year. And you know from checking recent sales, talking to brokers, that similar properties in that specific area are trading at around a 6% cap rate. Well, you can approximate the property's value by dividing the NOI, $45,000, by the cap rate, 0.006. That calculation, 45,000.006, gives you roughly $750,000.
Ah, okay. So it lets professionals quickly spot if something seems way overpriced or maybe underpriced compared to the market even before they think about getting a loan.
And it's worth noting, right, that cap rates aren't the same everywhere. Like, residential homes usually have lower cap rates than, say, a riskier commercial building. Oh, absolutely. Lower cap rates generally mean lower perceived risk or maybe higher expected appreciation. There's more demand for houses, financing is easier. So buyers accept a lower initial income yield. Commercial properties, maybe with tenant turnover risk, need to offer a higher cap rate to attract investors.
Okay, got it. Then there's a third one, the gross rent multiplier, or GRM. This sounds even simpler.
It is. GRM is arguably the simplest, quickest look. It's just the property's price divided by its gross annual rental income. That's the total rent you collect before taking out any expenses at all.
So GRM basically tells you how many years of gross rent it would take to pay back the purchase price, like a really rough payback period.
Exactly. It's useful for, say, quickly sifting through a big list of potential properties, or maybe in short-term rental analysis where gross income figures are often prominent. A lower GRM might signal a better price relative to the top-line income. And it's a big but because it ignores all expenses, taxes, insurance, vacancy, repairs, it can be really misleading. A property could have a great low GRM, but terrible operating costs that kill your actual profit. So investors might use GRM for that first quick filter, but they'll quickly move to cap rate and especially COC for the real analysis.
Makes sense. Now, all these metrics, COC, cap rate, GRM, they're about performance now. But the sources really hammer home this point about long-term wealth. The difference between just investing simply and really building wealth comes down to compounding, reinvesting the profits.
Yeah, the power of compounding. It's one of those things that sounds kind of abstract until you actually run the numbers. Let's go back to that idea of getting a 10% annual return. If you practice simple interest, meaning you take that 10% profit each year and, spend it, put it in a low-yield savings account, your total gain over, say, 40 years might only be around $4,000. It's steady income, but it's flat. No momentum.
Okay. But if you choose compound interest instead, you take that 10% profit each year and you diligently reinvest it back into the asset or another similar investment.
Then the growth just takes off. It becomes exponential, parabolic on a chart. By reinvesting, compounding that 10% return year after year, your total return over those same 40 years jumps from $4,000 to over $44,000.
Wow. So failing to reinvest in that scenario means you lose out on almost 90% of the potential return. Over $40,000 just disappears because you didn't let the profits make their own profits.
Exactly. It's the fundamental lesson. Wealth isn't just about finding one good deal. It's about treating the profits from that deal as new capital that must be put back to work continuously, generating its own earnings. Discipline pays off massively over time.
That's a powerful visual. Okay, one more metric to touch on. The internal rate of return, or IRR, you see this quoted a lot, especially in bigger, maybe private equity type deals. But there's a major catch with it, right? Something often overlooked.
There is, yeah, a significant caveat. The main issue with the standard IRR calculation is this hidden assumption baked right into the formula. It assumes that all the cash flow the project generates along the way, rent checks, money from a refinance, any distributions, gets reinvested immediately at the exact same rate as the project's overall IRR.
So if a deal boasts a fantastic 25% IRR, that number is only technically true if you can instantly take every dollar of rent money you receive and find another investment that also pays 25% and keep doing that perfectly for the entire life of the first investment.
Precisely. And as we know, the real world rarely works like that.
Right.
You can't always find another 25% deal instantly. More likely, that cash flow sits in a bank account earning, 1%, maybe 2%, while you hunt for the next opportunity. Because of this often unrealistic assumption, more sophisticated investors tend to prefer using the modified internal rate of return, or MIR.
Okay, and what's the key difference with MIR? How does it fix that problem?
MIR lets the analyst input a separate, more realistic rate for reinvesting those interim cash flows. You can tell the formula, okay, assume the project itself earns 25%, but assume any cash spun off only gets reinvested at, say, 5%, maybe based on treasury yields or your actual cost of capital. This forces a more conservative and usually more honest calculation of the true compounded return. It lets you really scrutinize the assumptions behind those big IRR claims and avoid being swayed by a number that might be purely theoretical. Much more realistic.
All right, so we've talked about calculating potential success. Now let's flip the coin and talk about avoiding disaster. We really have to look back at the hard lessons from the 2008 financial crisis. I mean, that wasn't just bad luck, was it? It feels like it was a total system failure, driven by some really dangerous financial inventions and, frankly, messed up incentives.
Oh, absolutely. The crisis is just a stunning case study in risk management completely failing, and it shows how these really complex, opaque financial structures can poison the entire real estate market. And the irony is the big idea behind all that complexity securitizing mortgages, bundling them into bonds, the initial pitch, was actually meant to be positive. The theory was, let's mass market this debt globally. It'll bring more capital into U.S. housing, which should lower interest rates, especially for, lower middle class families, make housing more accessible.
So how did something designed, at least in theory, to help affordability and efficiency turn into a global meltdown?
It boils down to a catastrophic failure of incentives, what economists call moral hazard. The system basically created this environment, this fast buck business, where checking quality just vanished. Think about the mortgage originators, the lenders on the ground. They could write loans, even incredibly risky ones like the infamous Ninja loans. No income, no job, no assets, collect their fee up front, and then immediately sell that loan off to Wall Street firms. Those firms would then package thousands of these loans together into bonds.
So the person making the loan, the originator, got paid instantly. They had zero reason to care if the borrower could actually afford the house or would ever make a payment. The risk was immediately off their books.
Yeah. Exactly. Zero skin in the game. And as the sources point out, any business where you can sell something and make money without worrying one bit about how well that product performs, well, it's inevitably going to attract, let's just say, sleazy people. It led to a complete breakdown in basic underwriting. Is this person likely to repay? That question became irrelevant. The risk was just passed down the line to the final investor, who often had no idea what they were actually buying.
And to hide this growing pile of bad debt, the products themselves were made intentionally complex, which brings us to things like CDOs, collateralized debt obligations.
Right. CDOs are like financial lasagna, layers upon layers of debt. Often they took pieces of mortgage bonds that were already considered troubled, the subprime slices, and bundled those together. They sliced these new bundles into different risk levels or tranches, and somehow got the rating agencies to stamp the top layers with AAA ratings, making them seem super safe. But the structure was so convoluted, so deliberately opaque, that even many analysts admitted they couldn't do the analysis. One insider famously called the stuff inside CDOs just all the pieces of shit we'd already shorted wrapped up together. Complexity became a shield for hiding risk.
The supposed watchdogs, the rating agencies like Moody's and S&P, they just completely missed it. Or worse.
It seems like a toxic mix. Partly, they were compromised by conflicts of interest. They got paid huge fees by the very banks whose products they were rating. Losing that business was unthinkable. And partly, they were just caught up in the mania, the prevailing belief that U.S. housing prices nationwide could never possibly fall. It was groupthink on a massive scale. Even when people presented clear evidence of fraud and mounting risk, the agencies were incredibly slow, or just unwilling, to downgrade these ticking time bombs. The sources summed it up well. Probably more morons than crooks, but the crooks were higher up. Lots of incompetence fueled by greed at the top.
Wow. Okay, so the big takeaway for you, the individual investor listening, is that you absolutely must assess the risk yourself. You can't rely on ratings or assumptions. And for managing risk in a specific deal, the first line of defense is the contingency clause. When you make an offer on a property,
contingencies are your escape hatches. They're absolutely essential. When you sign that purchase offer, you're generally locked into the price and terms. But a well-drafted contract must include specific conditions, loopholes, basically, that let you walk away without losing your deposit if something isn't right. It effectively gives you control over the property for a period, an inspection period, before you've actually finalized the purchase.
And what are the most common, most powerful contingencies, the main reasons you'd use to back out?
Typically, the two big ones are, 1, your inability to secure financing on acceptable terms. If you can't get the loan you expected, you can cancel. And 2, discovering undisclosed defects during the inspection. This is huge. You get the property under contract, then you bring in inspectors, home inspector, maybe specialists for roof, foundation, pests, whatever. If they find serious problems the seller didn't disclose, problems you're not willing to accept or negotiate, the inspection contingency lets you walk away clean. It allows for that deep dive, that due diligence after your offer is accepted so you know exactly what you're buying. Never, ever make an offer without an exit strategy.
Okay, that's crucial for the transaction itself. Now, what about protecting the assets after you own them? The sources stress using legal entities, not holding property in your personal name. It says holding it personally invites a tax.
Yeah, this is non-negotiable for anyone serious about building a portfolio. Holding investment property directly in your own name is just asking for trouble. If a tenant slips and falls, or you get into a car accident totally unrelated to the property, your personal assets and the property equity are potentially exposed. The standard tools for protection are limited liability companies, LLCs, and sometimes for more complex setups, limited partnerships, LPs. These entities create a legal wall between your personal life and your business assets and liabilities. If the LLC gets sued, generally, the lawsuit stops there. They can't easily come after your house or personal savings.
Okay, but we've heard sometimes lenders don't like seeing the property titled in an LLC's name right away, especially for conventional residential loans. They might argue you're trying to hide something. Why the objection, and is there a way around it?
Right, lenders can get sticky about this. Their main concern usually revolves around the due on sale clause that's standard in most mortgage contracts. That clause basically says if you sell or transfer ownership of the property and transferring it to your LLC technically counts, the lender has the right to call the entire loan balance due immediately. They worry it complicates their collateral position or might signal the borrower is in distress.
So how do you get the protection of the LLC without triggering that clause or upsetting the lender? What's the workaround?
The common practical workaround is this. You initially take title to the property in your individual name when you close the purchase. This satisfies the lender's standard underwriting. The loan is made to you personally. Then immediately after closing, like the same day or the next day, you execute a quitclaim deed transferring the title from your individual name into the name of your newly formed LLC or LP. Lenders often tolerate this because, crucially, you, the original borrower, typically remain personally liable for the mortgage debt even after the transfer. The LLC owns the property, giving you liability protection from tenant lawsuits, but the lender still has the property as collateral and your personal guarantee on the loan. It's a way to thread the needle, balancing the lender's security with your need for asset protection. Okay, so if we sort of tie all these pieces together, understanding leverage, knowing the key metrics, mitigating risk, the big picture conclusion becomes pretty clear. Real estate, if you want to succeed long-term and really optimize things, it has to be treated like a scalable, systemized business, especially when you start factoring in the incredibly powerful tax advantages the IRS code offers.
Yeah, that distinction, running it like a business versus treating it like a hobby, that seems like maybe the single biggest factor separating success from failure over time. Managing rentals just on the fly sounds like a recipe for inefficiency and unnecessary risk.
Absolutely. And a core part of that professional approach is rigorous financial separation. You absolutely must keep your rental property income and expenses completely separate from your personal finances. This is sometimes called avoiding commingling funds, and it's vital. Why? Because if you ever do face a lawsuit related to the property, a court could potentially pierce the corporate veil of your LLC, meaning ignore its protection if they see you haven't treated it as a truly separate entity. If you're paying your personal grocery bill from the rental account, the protection can vanish. And even without lawsuits, just keeping things separate makes bookkeeping infinitely easier, ensures you don't miss deductions, and simplifies tax time dramatically.
Right. Okay, so once you're set up and running it like a proper business, you start unlocking the tax superpowers. Let's start with the basics. Maximizing deductions just to offset the rental income itself.
Okay, so even if you're considered a passive investor by the IRS, which usually means you have a high-paying W-2 job or a significant pension income, and you can't use rental losses to offset that income, you still get significant benefits. You can deduct all your legitimate rental expenses, mortgage interest, property taxes, insurance, repairs, management fees, travel, etc. And critically, you can deduct depreciation. Depreciation is a non-cash expense, a paper loss, that represents the theoretical wear and tear on the property. For residential rentals, it's spread over 27.5 years. This deduction alone is often large enough to make your rental income completely tax-free on paper, even if you have positive cash flow hitting your bank account. And if you own multiple properties, a loss from one, maybe due to vacancy or big repairs, can usually offset taxable income from another profitable one, further reducing your overall tax bill from the portfolio.
Okay, that's powerful already. But then there's the next level. For those high-income earners, doctors, lawyers, executives who want to use potentially large real estate paper losses to offset their hefty job income taxes, they need to qualify for the real estate professional exception. Sounds like the holy grail, the tax get-out-of-jail-free card. But the rules are tough, right?
They are notoriously strict, yes. And you have to meet both main criteria every single year. First, you have to spend more than 750 hours per year materially participating in real estate trades or businesses. That's basically 19 full-time work weeks dedicated to things like managing properties, leasing, developing, construction operations. And second, this is the one that trips up. Many people, the time you spend on your real estate activities must be more than the time you spend in all other trades, businesses, or employment combined. The IRS really wants proof that real estate is your primary professional focus, not just a side gig you dabble in.
Wow, okay, 750 hours plus being your primary gig. And that 750 hours, or even the baseline material participation standard, which is often pegged at 500 hours, technically doesn't that apply to each separate rental property you own? So if you build up a portfolio of, say, 5 properties, are you looking at potentially needing 500 hours for each, meaning like 2,500 hours total? That seems impossible for most people.
You've hit on a crucial point where truly savvy tax planning comes in. Yes, by default, each rental property is considered a separate activity, potentially requiring separate proof of material participation, which, as you said, quickly becomes untenable. But there's a powerful tool in the tax code to solve this, the aggregation election. By making this formal election with the IRS, you're essentially telling them, I'm choosing to treat all of my rental properties as one single combined economic activity for tax purposes.
Okay, and what's the magic of doing that? What does aggregating achieve?
The magic is that once aggregated, you only need to meet that material participation threshold. Let's use the common 500-hour safe harbor as an example once for the entire combined portfolio. Instead of needing 500 hours for property A, 500 for B, 500 for C, you just need 500 hours total across all your aggregated properties. This massively lowers the time commitment and record-keeping burden. It makes qualifying as a real estate professional feasible for someone actively managing a reasonably sized portfolio, even alongside other activities, allowing them to potentially deduct significant real estate losses against their other high income. Huge advantage.
Got it. So aggregation is key to unlocking the RE Pro status realistically. Now, once someone is a qualified real estate professional, the next big strategy is maximizing those deductible losses, often through accelerated depreciation. What's involved in using these cost segregation studies?
Right. So standard depreciation, as we said, writes off a residential building's cost over 27.5 years, 39 years for commercial. Slow and steady. A cost segregation study is a detailed engineering and accounting analysis of the property. Experts literally break the building down into its various components and identify parts that have much shorter legal depreciation lives under the tax code.
So instead of just one lump sum depreciating slowly over decades?
Exactly. They might identify, say, the carpeting, certain fixtures, maybe some appliances. Those can often be depreciated over just 5 years. Things like paving, sidewalks, landscaping, maybe 15 years. Specific land improvements might be 7 years. By breaking out these components and assigning them these shorter lives, you accelerate the depreciation deductions into the early years of ownership. This can create a very large upfront paper loss in year 1. The sources indicate this deduction can be massive, potentially tens, even hundreds of thousands of dollars, depending on the property. For a qualified real estate professional, this accelerated depreciation loss can not only wipe out any tax owed on the rental income itself, but the excess loss can then flow through to offset taxes on their W-2 wages or other business income. It's a primary tool for dramatic tax reduction.
Okay, that's impressive. Finally, let's talk about strategies for when you eventually sell the property. Deferring taxes is key to letting that wealth compound. The 1031 exchange is almost legendary in real estate circles.
The 1031 exchange, or like-kind exchange, is incredibly powerful. It allows you to sell an investment property and defer paying capital gains taxes and depreciation recapture taxes, potentially indefinitely, as long as you follow the strict rules to reinvest the proceeds into another like-kind investment property. Keeps your entire capital base working for you, tax-deferred.
And the rules are strict. What are the absolute non-negotiable deadlines everyone needs to know?
2 critical deadlines. First, the 45-day identification period. From the day you close the sale of your old property, the relinquished property, you have exactly 45 calendar days to formally identify, in writing, the potential replacement properties you intend to buy. You can identify up to 3 properties usually, or more, under specific rules. Second, the 180-day closing period. You must actually close on the purchase of one or more of those identified replacement properties within 180 days of selling the original property. Miss either deadline, even by a day, and the entire tax deferral is typically lost. And crucially, to get the full tax deferral, the value of the replacement property you buy and the amount of debt you take on, or cash you put in, generally needs to be equal to or greater than the property you sold. You have to trade up or equal to avoid paying tax on any difference.
Okay, 45 days to ID, 180 days to close. Very tight. What if a 1031 doesn't work out or isn't suitable for some reason? Is there a backup plan for tax deferral? The sources mentioned installment sales.
Yes, an installment sale is another useful, though less complete, tax deferral strategy. It's simply defined as any sale of property where you receive at least one payment after the tax year in which the sale occurs. So instead of getting all the cash up front and only tax on the entire gain in that 1 year, you might structure the deal so the buyer pays you over, say, 5 years. The benefit is that you generally only pay tax each year on the portion of the gain that corresponds to the principal payments you actually received that year. It allows you to spread the tax impact over multiple years, potentially keeping you in a lower tax bracket each year, or just deferring the bulk of the tax liability further down the road. It's a way to manage the timing of the tax hit. Hashtag tag outro.
So wrapping this all up, what does it really mean? We've gone through a lot here, a real deep dive into the guts of real estate finance. From seeing that low interest rates maybe aren't so low historically, to understanding how powerful leverage can be for good and bad, to dissecting the crazy complexity and, frankly, the moral failures behind the mortgage bond crisis. It really feels like success in this game isn't about luck. It depends heavily on financial literacy, on understanding these numbers and executing strategies very carefully.
Absolutely. Critical thinking is just paramount, isn't it? Especially today with so much information and misinformation flying around. Hopefully, listeners now feel they have a more solid framework, a way to assess risk and reward using professional tools, whether they're looking at a small rental down the street using cap rates or trying to understand news reports about complex financial instruments like CDOs again. You've got the grounding now in leverage, compounding, risk mitigation, tax optimization, the core principles.
Right. And we've seen throughout this how the value of money itself, the structure of debt, it's all constantly moving, constantly evolving. So if we think about basic economics, competition, efficiency, those things are supposed to push producers to charge lower prices, right? Which should benefit consumers.
Which leads us to maybe a final provocative thought to leave you with. What happens to something like housing prices and the stability of the whole market when the incredibly complex financial system built around housing, a system theoretically designed to inject capital, increase efficiency, and lower costs for borrowers through things like securitization? What happens when that very system becomes a source of massive, hidden, systemic risk? As we saw vividly with the subprime disaster, sometimes the biggest risk isn't just the price tag on the house itself. It's understanding the intricate and sometimes fragile financial architecture holding it all up. Keep asking what's behind the numbers, not just focusing on the number itself.